Many people think that to invest successfully, they have to be good at financial analysis, read economic news every day, and constantly keep track of whether the market is going up or down. But in reality, the more people follow the market, the more risky it seems. When prices go up today, they worry that they are buying too high. When prices go down tomorrow, they worry that they are losing money. And just like that, the more people watch, the less courage they have to put their money in. Over time, they slowly come to the conclusion, maybe investing just is not for me. But the problem may not be that your knowledge is limited, or that you do not understand the market well enough. So where does this fear really come from? Let us find out right now. Where does this fear come from? Have you ever asked yourself why we can easily spend a few $100s on a luxury item, but feel scared when we think about putting that same amount of money into an investment fund? In reality, our fear is not random at all, because your fear has deep roots in two foundational layers: family scripts and survival instinct. First, let us look at what psychologists call financial DNA. According to expert Brad Klontz, every person carries a money script that is unconsciously formed before the age of 13. These are the beliefs we absorb directly from our parents. Just look at Bobo's case. Bobo's father once saw someone he knew put the entire family's life savings into the stock market, only to lose it all in a short period of time after the 2008 financial crisis. That shock haunted Bobo's father for years. From then on, he always told Bobo, investing is gambling. Whatever money you earn, just put it in the bank because at least it still earns some interest. Do not take your money and put it into risky investments. To young Bobo at the time, his father's words became a survival script engraved deep in his subconscious. As an adult, every time Bobo thinks about investing, his brain automatically activates an alarm signal. Investing equals risk, and risk equals loss. This is not just Bobo's story. This is something that has happened to millions of people around the world across generations. People who lived through the Great Depression in 1929 passed their fear of the market down to their children. People who witnessed the dot-com bubble burst in 2000 taught the next generation that investing in technology was dangerous. And people who lost money in the 2008 crisis caused an entire younger generation to grow up cautious and skeptical about the financial markets. Fear keeps spreading from one generation to the next, not through books, but through emotion. The second foundational layer that Bobo has to face is survival instinct. Bobo needs to understand that this fear is not actually his fault. It comes from the way the human brain has been programmed through evolution. For thousands of years, our ancestors lived in an environment where losing a resource like food could mean death. So, the human brain was gradually programmed around one principle. Protecting what we already have is more important than searching for something new. That principle helped our ancestors survive. But now, it is causing trouble for Bobo in the modern financial market, because Bobo's brain cannot tell the difference between losing food in the forest and an investment portfolio dropping by 8%. To the brain, both are losses, and both activate the same response: stop, retreat, and protect what is already there. That is why every time Bobo sees his portfolio turn red, he does not think about the next 20 years. He wants to get out immediately. As Morgan Housel wrote in The Psychology of Money, behavior is more important than intelligence. Bobo's brain does not care about compound interest or long-term financial freedom. The brain only wants to protect the money he has today. And if Bobo does not recognize this, he will continue letting his survival instinct make financial decisions on behalf of his rational mind, and he may unknowingly pay the price with 10 to 20 years of failing to build wealth. This fear is a natural reaction of the brain, but overcoming it is Bobo's responsibility if he wants to protect his own financial future. Trap number 1. Loss aversion. After understanding where his fear came from, Bobo decided he could not keep watching inflation eat away at his money. So he took advice from Lulu, a close friend with more than 2 years of investing experience. He opened an account and put in his first $1,000 to invest in a reputable stock fund. But just 2 weeks later, the market started shaking. Looking at his phone, Bobo saw his portfolio drop by 8%, meaning he had lost $80. For many people, $80 might not seem like much, but to Bobo, it was almost a full week of food money. That night, he could not sleep. His mind kept circling around that $80 that had just disappeared. Unable to handle the pressure, Bobo hit the sell button to get his money back. When the cash returned to his account, he finally breathed a sigh of relief and told himself, "Investing really is not for me. I would rather just hold cash." So why did Bobo panic so much when he still had $920 left? The answer lies in prospect theory. introduced by psychologists Daniel Kahneman and Amos Tversky in 1979. Their research showed that the pain of losing $100 can feel 2 to 2.5 times stronger than the joy of gaining $100. In other words, Bobo's brain exaggerated that $80 loss and made it feel as painful as losing more than $200. This does not mean Bobo is weak. It is how the human brain was wired back in the hunter-gatherer era to protect survival resources. The problem is that Bobo is using a prehistoric survival system to make decisions about modern financial numbers. As a result, according to research by the financial organization Dalbar, over the past 30 years, the average individual investor has earned only about 3% to 4% per year, while the broader market has grown by about 10% to 11% per year. The biggest reason is that many people act just like Bobo. They sell when they are scared and buy when they are excited. In investing, loss aversion usually leads Bobo to two mistakes. First, he refuses to cut losing positions because selling would force him to face the real pain of losing money. So he keeps holding falling stocks just to avoid that feeling. Second, he sells winners too early. As soon as his account is up by a few dollars, he worries the gain will disappear, so he sells right away and never gives his assets time to grow. Bobo rushed to sell after losing $80. But if he had stayed calm for another 6 months, that portfolio could have recovered and grown to $1,300. This trap feels like it is protecting him, but in reality, it pushes him into the most dangerous behavior in investing: buying high and selling low. Trap number 2, recency bias. Bobo thought he could relax after pulling his money out, but the human mind forgets quickly. 1 year later, the market entered a strong rally. Everywhere Bobo looked, he saw news about new records. More importantly, Lulu, his close friend, kept showing off his profits. For 5 straight months, Lulu's portfolio was completely green. Bobo's brain started convincing him. Last time I was just unlucky. Look at the market now. It is rising so strongly, so it will probably keep going up. Right when the market was near its peak, Bobo decided to invest even more money than before. But 2 months later, the market started a sharp correction and fell 15%. Instead of staying calm, Bobo panicked again. He looked at the falling chart and imagined the worst. It is dropping now, so it must keep collapsing forever. Maybe this is another 2008 crisis. Without hesitation, Bobo sold everything again, right near the bottom. The truth is, Bobo was trapped by recency bias. This is the mental shortcut that makes our brain believe that whatever just happened recently will keep happening in the future. When the market rose for 5 months, Bobo's brain assumed it would rise forever, so he bought even at high prices. But when the market fell for only 2 months, his brain assumed it would keep crashing, so he sold in fear. This is one reason financial bubbles form, and why market crashes often last longer than they should. Everyone starts believing the recent trend will continue. To see this more clearly, Bobo should look at the long-term numbers. From 1950 to 2019, the Dow Jones Industrial Average in the United States gained about 11% per year on average. But during those 69 years, there were still many sharp drops of 20% to 40%. The clearest example was the 2008 financial crisis, when the United States market fell as much as 57% from its peak. At that time, millions of people felt exactly like Bobo. They sold at the bottom because they believed the market was going to zero. But by 2013, the market had fully recovered, then went on to rise 4 times over the following decade. The result is clear. Bobo did not just lose money. He also lost the chance to build wealth because he let short-term emotions control his long-term vision. This trap turns Bobo into the kind of investor who buys at the top and sells at the bottom. Trap number 3, herd mentality. After 2 painful failures, Bobo promised himself he would be more careful than ever. But during a group hangout, the group chat suddenly exploded like a storm. Lulu, the experienced one, was excitedly talking about a new tech stock he had just bought. Right away, Mimi, another friend who was usually very careful with money, jumped in and showed a screenshot of her account, already up 20% in just a few weeks. Seeing 2 of his closest friends making money so quickly, Bobo started feeling restless. He had officially fallen into FOMO, the fear of missing out. Bobo told himself, Lulu is smart and he bought it. Even cautious Mimi is making money. If everyone in the group is in, how could I be wrong? In the end, afraid of being the only one left out, Bobo put all his money in right as the hype reached its peak. Just 3 weeks later, bad news hit the company. The stock price dropped hard, leaving Bobo shocked with a major loss, while Lulu and Mimi had already taken profits earlier. Bobo asked himself, how could I make such a blind decision? The answer is that he was being controlled by a survival mechanism from tens of thousands of years ago, when our ancestors lived in the wild and hunted for food every day. Back then, if Bobo saw his entire tribe running, the best way to survive was to run with them immediately, instead of standing still to analyze whether a tiger was coming. But in the modern financial market, that shortcut can become the fastest road to disaster. Bobo needs to understand one harsh rule. When everyone around him, from Lulu to Mimi, has already bought, buying pressure may already be exhausted, and the price is often near its highest point. Late buyers, driven by emotion, like Bobo, often become the ones left holding the bag for those who got in early. Looking back at history, Bobo can see this trap repeating for hundreds of years. From the tulip bubble in the Netherlands in 1637, when people were willing to trade an entire house for a flower bulb because everyone else was buying, to the dot-com bubble in 2000, which wiped out millions of investors who chased internet companies with little real revenue. More recently, there was the crypto craze in 2021, when Bitcoin peaked near $69,000, then fell to around $16,000 just 1 year later. The pattern is the same. Many of the people hit hardest were pulled in by FOMO right near the peak, just like Bobo. After 3 failures, Bobo began to feel exhausted and started falling into procrastination. Trap number 4, hyperbolic discounting. After all the shocks, from losing money out of fear to getting swept up by the crowd with Lulu and Mimi, Bobo learned one lesson. I cannot invest based on emotion anymore. I need to do this properly. So he made a detailed plan, chose his portfolio carefully, and promised himself, next month, I will definitely start again. But when that next month arrived, Bobo looked at the extra money in his account and told himself, I bought a new watch this month, so money is a little tight. I will start next month. Then the next month, there was a trip. Or sometimes he simply thought, the market is too volatile right now. I should wait a little longer to be safe. Just like that, 3 years passed in the blink of an eye. Bobo's money stayed in a low-interest savings account. It did not grow, and it did not really work for him. Nothing terrible happened. The market did not make him lose more money either. But the harsh truth is that Bobo still never truly started. And he did not even realize he was losing the most valuable thing of all: time. Economists call this the trap of hyperbolic discounting. It is a strange glitch in the brain. We tend to choose small rewards right in front of us over much bigger rewards far in the future. For Bobo, a good cup of coffee or a new tech gadget today gives him clear, instant satisfaction. Meanwhile, the idea that he could have $500,000 at age 55 feels vague, distant, and hard to see right now. This is similar to the famous Stanford marshmallow experiment in 1972. Children who could wait and skip 1 marshmallow now to get 2 marshmallows later tended to do better financially as adults. Unfortunately, Bobo's instinct keeps pushing him to eat the marshmallow right now, instead of waiting for the future. The cost of Bobo's delay is so huge that the actual numbers can shock anyone. For example, if Bobo starts investing at age 25 with just $200 per month, at an average return of 10% per year, by age 65, he would have about $1.3 million. But if he keeps waiting until things feel safer and does not start until age 35, with the same monthly amount and the same return, by age 65, he would have only about $452,000. Just 10 years of hesitation would cost Bobo nearly $900,000. That huge amount is not lost because he invested badly. It is lost because he did not start earlier. Even Warren Buffett, the investing legend admired around the world, once pointed to something that surprises many people. The secret behind his success is not just picking the right stocks. It is time. He started investing seriously at age 10. And here is the number that should make anyone pause. Out of Buffett's $84.5 billion in wealth, about $81.5 billion was created after he turned 65. That means more than 96% of his wealth came from the power of time, not from genius decisions made overnight. Time is the most powerful form of leverage in finance. Those who use it early win. Those who let it pass pay the price. And Bobo is quietly paying that price every day, while his savings account sits there earning interest that is not even enough to beat inflation. This trap does not cause instant pain like losing $80 did before, but it is quietly stealing Bobo's future freedom. Solution. So how can Bobo escape? After seeing the 4 traps surrounding him, Bobo realized he could not rely on willpower alone to overcome them. Instead, he needed a clear action system to lock away the instincts that kept leading him in the wrong direction. To escape trap number 1, loss aversion, Bobo decided to follow one rule. Only invest money he can accept seeing drop in the short term. Instead of putting in all his capital at once, Bobo started with smaller amounts, so his brain would not go into red alert every time the market shook. He also learned to delete the app he used to check prices every day. Instead, he only reviews his portfolio once every quarter. This helps Bobo separate his emotions from temporary market swings. For trap number 2, recency bias, Bobo's solution was to change his perspective. Instead of staring at the green and red charts from the last 10 days, Bobo now opens the 10-year historical chart whenever he is about to make a decision. He put a sticky note on his computer screen that says, "Every crisis in history has eventually recovered." This reminds Bobo that markets move in cycles, and what is happening today will not last forever. Thanks to that, he no longer gets pulled into the old pattern of buying at the top and selling at the bottom. To avoid trap number 3, herd mentality with Lulu and Mimi, Bobo created a filter for himself. Before buying any asset, he asks, "Do I truly understand how this works? Or am I only buying because everyone is talking about it?" If Bobo cannot explain it clearly enough for a 10-year-old to understand, he does not invest. He understands that in investing, protecting his capital matters far more than chasing every opportunity he sees in a friend's group chat. Finally, to beat trap number 4, hyperbolic discounting, the biggest enemy behind procrastination, Bobo used the strongest weapon, automation. Instead of waiting until the end of the month to see how much money is left to invest, Bobo sets up an automatic transfer on payday. The money goes straight into his investment account before Bobo even has time to think about buying a coffee or a new tech gadget. He also uses a dollar-cost averaging strategy, meaning he invests a fixed amount every month, whether the market is up or down. This way, Bobo no longer has to stress about finding the perfect time to start, because the best time is right now. After everything he went through, Bobo realized that naming his fear was the first step to defeating it. He no longer tries to become a genius at calculations. Now, Bobo focuses on mastering his own emotional waves. Instead of sitting still in fear, Bobo begins a new journey with a calmer mindset. He understands that his real problem was never money. It was always psychology. And the good news is, psychology can change. Investing is not a battle against the market, it is a battle with yourself, and Bobo is ready. If you still have any concerns or questions about personal finance, feel free to leave your thoughts in the comment section below. We will find the answers together in the next videos. Goodbye, and see you again soon.